What's up, y'all? Today I'm going to be talking about my method for quickly paying off debt using something called debt consolidation. Okay, so if that's something that interests you, if you're looking to try to get a bunch of credit card debt paid off at once, then be sure you stay tuned. What's up, y'all? My name is Tomy Boboy, your credit and personal finance coach. If this is your first time on my channel, I'd just like to say welcome. Typically on this channel, I'm talking about things related to credit and personal finance. So if you're interested in improving your credit or achieving financial freedom, be sure you hit the subscribe button down below so you don't miss any of my future videos. Now let's go ahead and jump into debt consolidation. Now, credit card debt has become a big issue, especially here in the US, because people usually what happens is you end up using your credit cards for things that you know that you might not be able to pay at that exact moment, but you're eventually going to pay off. And it's kind of like a snowball effect where you just keep adding more and more stuff on it, thinking that you're going to pay it off like next week or the week after. And eventually it gets to a point where now you're stuck with, something that should have been just like $100 that you use. Now you've used $500, $1,000, $5,000 in credit card debt, and you're stuck in the vicious cycle of paying off using just monthly payments. Okay. And that's really where the big issue of it comes, is because you making the monthly payments, it has two effects on you. One, credit card debt affects a big portion of your score. It affects about 30% of your score, which comes out to about 165 points that you could either gain or lose because of your credit card debt. Okay. Now, the other part of it is the interest rate. Okay. A lot of people don't realize that, just because of that interest rate, majority of the time, whenever you're making that minimum payment, most of that minimum payment is going to paying off the interest. Right, the interest that you owe it's not the majority of it is going to that interest, and then a very small of it is actually going to paying down the principal or the actual amount that you owe. Okay, and so that's why I typically recommend to people that you want to try to find ways to be able to get out of that vicious cycle, because if you don't, it could be you borrowed maybe $500 and it's going to take you 2-3 years to be able to pay off that full amount. Right. And the crazy thing is you can actually look on your credit card statement and they tell you how long it would take you to pay off that the actual amount of debt that you have on those credit cards based on years. So, if you owe $500 and you only pay the minimum payment, it'll show you on there, hey, this is going to take you 5 years to pay off if you keep making the minimum payments, so on and so forth. And that right there is enough to give you an idea just how crazy or how expensive credit card debt actually is. Now, some of you guys might be wondering, why should you use credit or debt consolidation, right? The real reason why I recommend debt consolidation is because you're able to leverage lower interest payments. So typically the idea is you're looking for loans that can be used to pay off the credit cards, because those loans, once you wrap all those credit card debt into a loan, that loan is going to be a lot cheaper for you in terms of how much you got to pay in terms of every month, and in terms of interest, right? The interest is supposed to be a lot lower. Now, one thing I do want to touch on, and this is mostly for people who have, like, let's say you have 3 or 4 different credit cards. One thing I do want to mention is that typically whenever you consolidate, let's say 4 different credit cards that have debt on them, you consolidate it into one loan, your monthly payments might be a lot lower than what it previously was. But I typically recommend to people that you still try to pay off either the same amount or more than what the minimum payment is for that new consolidation loan. The reason being is you still want to make sure that you're paying off that debt as fast as possible. That way you end up paying less interest. Okay, so don't necessarily look at those smaller payments as meaning that you can just take your time paying off that debt, because whenever you're going to get a house, or even if you're going to apply for a car, they're going to see those that you're having to make those payments, and it's something that could affect you and cause you to end up not getting qualified for whatever product you're trying to get. Now, here are some ways that I recommend that you do this. Okay, now, even though I say consolidation, like debt consolidation loans, you can actually do it another way, right? And the one way that you can do it is what's called 0 APR credit cards. Now, honestly, this can be the best way if you position it right. Okay. The great thing about 0 APR credit cards these cards that they have those promotional periods where they say, you get 1 year with the card, and 0 APR, meaning you don't pay any interest for the first year. Okay, so those cards can be great for you to roll any old credit card debt into those new cards, and that way you're not really paying any interest. Now, typically these companies will or these credit cards will charge you a balance transfer fee, which means like you're transferring the balance of one credit card to another. They will charge you a balance transfer fee of a couple percent points. So maybe it'll be like 1, 2, 3%, something like that. But it's a lot better than you keeping that debt on that original credit card and them charging you an interest rate of 20, 30%, right? So this, I think, is really, one of the better ways to do it, because it attacks the interest rate part of the issue, right? And so you're making sure that you're paying, all your money is going to the actual principal or the actual amount that you owe, as opposed to majority of your money going to just pay off interest every month. Now, one caveat with this thing is that you still will be taking a hit to your to the credit utilization category of your score, that 30% of your score, since you're really just moving debt from one card to another. Right now, it should decrease a little bit, or that part of your score should improve a little bit, because you are opening a new credit card, which means you're going to have an additional credit limit added, right? But you'll still see a decent, like, you're still going to take a decent hit either way, right? Just because you're moving the money over, you're not really doing much, okay? And because of that, there is another option, which is debt consolidation loans. Now, with debt consolidation loans, you're going to pay interest, but the interest is typically going to be a lot lower than what you normally would pay. Okay, when it comes to credit cards, you can see interest rates around, let's say, anywhere from 17 on the really good cards, 17%, all the way up to 29%, right? And I think there's even some cards that go above that. I'm not sure, but that's typically the range you're going to see. And more than likely with your card, it's going to be closer to 25, 30%. Okay. Now with debt consolidation loans, I've seen them go as low as 6%. Okay. Which that's going to be a game changer if you think about like how much more of your money is going to go towards the actual principal or the actual amount that you owe. The other benefit is, since you're moving all the credit card debt into a debt consolidation loan, which is really, I mean, if you look at it, it's really just like a personal loan, then it's actually going to boost your score a lot more, because you're taking off all that credit card debt and you're getting it out of the amounts owed category, which is that 30% we've been mentioning. So you could see a huge boost, and it's possible that you can earn back the majority of those 165 points that you had previously lost. Okay, so that's really where I see the biggest gain from it. Now, what I'll do is I'll link below to a few different debt consolidation companies that allow you to, they'll look at your credit score. Normally, most of them are going to do a soft pull, but I'll put down below if they do need to do a hard pull. But most of them will do a soft pull on your credit to let you know if you're qualifying and everything. So it's really comes at no risk. But I'll link to those, like a few different companies that I know of down below that you can check out, in case that's an option that you want to do. In terms of 0 APR credit cards, there's not really much I can do in terms of linking them, because those are just offers that they have that come and go. So you'll just want to, do a Google search looking for those type of balance transfer cards, and then you'll know, depending on whatever time you're watching this video, what the best options are. All right, so that's going to be it for this video, guys. Now you have a technique that you can use to be able to eliminate a large chunk of your credit card debt and be able to pay them down as soon as possible. Okay, so be sure that if you enjoy this video, you throw a like on it, and that you hit the subscribe button down below, and also throw in the comments any types of questions you might have, or any other videos that you'd like to see, and I'll be sure to take the time to shoot those for you. Okay, now that's gonna be it for this video, guys. I will see you at the next one.